The complete guide to supply and demand in Forex. The driving force behind changes in price is supply and demand. When there are more buyers than sellers, the market price will move up. Conversely, when there are more sellers than buyers, the market price will move down. When buyers and sellers are more or less even, the market will range. These simple concepts are very powerful and allow us to analyze naked charts in order to determine where the price is likely to go. Since the current price is determined by past prices, this is a very simple method of technical analysis and a highly successful trading style that makes it possible to identify a specific entry price and a supply zone or demand zone. Stop loss and take profit levels are also easily identifiable. Supply and demand in Forex trading provides a simple no-brainer system that gives good profits. All this without all the complexity of technical indicators, but rather through the interpretation of the bear price action itself. Supply and demand trading is a system for identifying zones of supply and demand that we can use to make trades that give us a statistical advantage. How and why are supply and demand zones created? Supply and demand zones are defined when an imbalance in the buyers and sellers occurs. Please like and subscribe to help us grow as a channel and share more videos. Supply and demand Forex analysis. It will always be the simplest, most atomic way of explaining why price changes. This is because the market is the place where sellers and buyers meet to conduct the business of exchanging the product for cash. By understanding the supply and demand concept, it will be very simple to spot this zones on charts. Although this would be a hindsight observation, it will give us a good hint of where to look for our trades in the future. It is key to understand that the theory of supply and demand Forex trading is based on analyzing and defining zones in the past. These zones determine where should we expect the price to react in the future. It's easy to see supply and demand on charts in any time frame, once we understand supply and demand balance and imbalance. First, we look for a balance zone. This is a ranging consolidation zone of price. It represents buyers and sellers who are at peace and in balance. Every product offered at this price finds a buyer. For every demand to buy, there is a seller. The price is not negotiated and everyone is happy with price levels and stocks. Next, we look for a breakout of that range. If it breaks out upward, it represents an increasing demand and a lack of sufficient supply. If it breaks out lower, that represents an increasing supply and buyers reducing their demand. How to identify demand zones on price charts. When this occurs, the area underneath the point where the candle breaks through the body of the past two candles is a demand zone, as you can see in the graph. How to identify supply zones on price charts. The method for identifying supply zones on charts is similar to identifying demand zones, only reversed. You will be looking for a large candle or series of candles that fall beyond the bodies of the previous two candles in a downward direction. The area above this is a supply zone. At this point, we are looking for a significant move in the direction of the large candle. The stronger the move, the stronger the demand or supply zone is. It also suggests that the price will move in the same direction again when the price returns to this level in the future. We want the price to stay away for a while. If it comes right back, it is not a significant move. In other words, we want the move to be significant in both price and time. We now know where to enter the market and where to set our stop loss and take profit. Spartan Trading Academy. For several months we have worked consistently to create it and it's finally available for you. This academy will include more than 30 videos that will cover market structure, price action, chart patterns, advanced supply and demand and much more. Check the link on the description of this video to join. How to trade supply and demand zones. Planning the entry. Simply enough, using the understanding of supply and demand, we would always be buying low and selling high. Buying at demand zones and selling at supply zones. Therefore, we will be buying against the direction the price is moving, because we have a good estimation for when the price is about to reverse. The point of entry for the order is at the breakout level of the zone. This is known as the origin level. Thinking in terms of supply and demand, the breakout level is where we can see a confirmation of imbalance. One side has the upper hand on the other. As explained, once an imbalance occurs, orders are waiting to be filled at this very price level. So we have a statistical edge to assume another price imbalance will occur at that level once again. Stop loss. The stop loss should be placed just beyond the extreme end of the zone. This price level is known as the base. For a supply zone, this would be the extreme low produced by the large candle and the group of candles near it. For a demand zone, this would be the extreme high produced by the large candle and the group of candles around it. This point corresponds with the top of a demand zone and the bottom of a supply zone. Take profit. The first take profit is the first demand level when shorting and the first support level when going long. So, when a new support level forms, you should set up your trade and wait for the next demand level to form. Once it has formed, you would set up a take profit, whether partial or full. Perhaps if your trade is against the larger trend, it would be prudent to close the position entirely, or you could only close out a portion of the trade. Then when you hit a new demand or supply level within the constraint of the current stop loss, you could enter a new trade, and so on. Vice versa. The same theory holds true for the reverse action. When large volumes are gathered at a level above the price, the supply increases. This can cause the price to drop sharply when it hits the supply zone. Traders engaging in supply and demanding trading like this need to be on the lookout for these two important levels in their charts: the demand zone and the supply zone. Limit orders, set and forget method. Supply and demand forex trading is based on the predefined price. This is the beauty and the power of trading supply and demand. It provides, with high probability and accuracy, the location where the price will be reacting in the future. With this information, it would be very simple to set pending orders to be automatically triggered once the price hits a future price level. This allows us to set up trades using limit orders and let the market develop at its own pace. You can wait in comfort for your trades to be triggered whenever it happens, with no further effort. Buy limit orders. Once a take profit level has formed, you have nothing stopping you from setting up a buy limit order to enter the position when the price returns to the identified demand level. Since you know all the key parameters for the trade, you can simply set up limit orders and specify the entry, stop loss, and take profit. Recommended broker is Longhorn FX. It's an ECN broker dedicated to delivering a superior trading experience to traders. Sell limit orders. Similarly to the buy limit order, you can set up a limit order to automatically enter a sell market order when the price re-enters the demand zone. To sum it up, look for a price move that speeds away travel far away and stays away for a long time. When the price arrives back to the original level, the odds are high that it will go back up again. Confirmation entry. The set and forget method has some disadvantages. A supply and demand zone will not always react with a reversal. Sometimes, the reaction will be weak and quick. There are several events that can wash out these zones, such as economic news releases or even an error in our analysis. Supply and demand pros and cons. The pros. The nice part about trading in a supply and demand system is that the price levels are predefined, which means you set them and wait. This gives you a well-deserved break from the screen without having to monitor every single movement waiting to make a trade. Related to screening time, when you trade with this method, you also clearly see price move with reason and logic. There are clear machinations at play when traders are buying and selling within supply and demand zones. The method is governed by perhaps the most fundamental principle in economic theory. The cons. If you can successfully execute this strategy, there aren't many cons here. The only thing to really be aware of is that this method isn't a stand-alone trading plan in itself. Supply and demand trading should be incorporated as part of your larger, more comprehensive market strategy. Supply and demand conclusion. The supply and demand trading technique, using support and resistance levels, has great advantages. It can be traded as set and forget with pending orders. You know all the trade values ahead of time: entry, stop loss, take profit, and it provides a great return-risk ratio. However, like all techniques, it must be practiced and mastered. There are many caveats to be aware of. It takes time to learn how to handle them all. We advise you to learn more and understand that it is not quite as simplistic as it seems, nor is it a pure systematic trading strategy.